Welcome to Peoples and Things, a podcast about human life with technology. I'm Lee Vinsel, an assistant professor of science, technology, and society at Virginia Tech. Today, my guests are Brent Goldfarb and David Kirsch, both of whom are professors of entrepreneurship and strategy at the University of Maryland's Robert H. Smith School of Business. Today, we'll be discussing their 2019 book, Bubbles and Crashes, The Boom and Bust of Technological Innovation. And we'll also be talking about some of their past work and accomplishments along the way. Brent and David, thanks so much for taking the time to talk to me today.
Yeah, thanks for having us.
Great to see you. Great to see you.
We hope you won't regret it.
We'll see. Guys, what led you to write this book, and what were you hoping to accomplish with it?
Oh, boy. David, do you want to take a crack at this? Or should? All right, so I'll start. We had written a previous paper on the dot-com boom and bust, and we were frustrated by that paper because it had what we'd like to call an N of one. So we studied the dot-com boom and bust, and you can't really understand the causes of a bubble if you just have one bubble, and you call it sampling on bubbles. So we wanted to look at a broad range. We decided to look at a broad range of technologies and try to figure out if we could find antecedents or underlying causes or things that made certain technologies more or less likely to be subjects of market speculation. But that was just a paper. And I, in my ignorance, pulled David along to write a book, which he did not want to do because he'd already done that. And he's like, you don't want to do that. And I won that battle mostly because what we were trying to do didn't fit into a paper. So we had no choice. And in the process made at least my parents very happy because now they have something to hold up the short leg of their coffee table.
Right. You were not a book writer previously, Brent.
This is my first book, yeah.
Is that right? That's right. You guys lay out a kind of simple and clear model, I think, of how bubbles form. So do you want to start by outlining that for us? David, you want to give it a shot?
Yeah, I think, the one thing maybe Brent left out in that account of the book is that the working title for most of its life was "When Are There Not Bubbles?" Right? And so I think that was, we were really trying to bring some kind of methodological rigor to the study of bubbles and, really focus on finding something that was associated with bubbles, but not, always so. So the idea was, sometimes certain technologies generate bubbles and certain technologies don't. And so that was really the trying to figure out like which ones do and how would we kind of describe or characterize those technologies that do cause bubbles and and kind of how does that path work. And so we ended up with this kind of 4-part theory of bubbles where you sort of need uncertainty. So all of these big technologies have a degree of uncertainty associated with them. You get something new. How is it going to be used? Telephone comes along. How quickly is it going to be adopted? Which customers are going to use it? What different kind of applications will they find for it? Will it, men use it, women use it, farmers, business people, to talk or to, to transact business, trade stocks, what have you. So you need uncertainty associated with this innovation, and then you also need, or to be common in most of these cases, is you need lots of novice investors who don't know what they're doing. So, whether that's because entry costs into a market have fallen, or there are new markets opening, new ways to trade, new kind of venues for exchange. So those two features we knew were really important, and lots of people who'd studied bubbles beforehand had seen that. I think where we added something new to that was that we observed that you need this, what we call a pure play. There has to be something that people can focus on, that's really a clear, the kind of embodiment of the uncertainty that the new investors can focus on. So in the .com era, for instance, in that paper that Brent was talking about earlier, there were all these the .com IPOs, and those companies just tended to attract. It was a very clear pure play. If you were, it wasn't embedded in a bunch of other technologies or in a imbricated in some complex system. It was just, here it is, bet on it. And then I think the fourth piece of it was the importance of narrative. We call it narrative, but the idea that and we sort of picked this up a little bit from Robert Schiller, and he has this book on narrative economics, sort of calling for the importance, invigorating the economics with an appreciation of the importance of narrative, which I think cuts very much against the grain to a lot of practitioners in economics, but which is obviously bread and butter to those of us who study history of technology, history of business, etc. And the idea there is that the narrative is what sort of coordinates everyone's thinking about the thing. So you need the narrative and the pure play to give the novices something to bet on the uncertainty. If that puts all four things into maybe one sentence for you.
Yeah. Brent, do you want to add anything on the model?
I'll just add that, no, I think David did an excellent job. The surprising thing, at least to me, was just the power of the narrative to transform both industrial history and industry outcomes. And there's limits in some sense. There were very real. One of the bubbles we study is aviation in the late 20s, and there's the narrative runs into the wall that is the limitations of the technology and how quickly that technology can improve, even with a whole bunch of investment. And so it's not all powerful, but it is compelling and drives the behavior of many people and has a lot of social welfare implications. I think people get caught up in stories to their detriment. But at the same time, you need it in order to coordinate some sort of vision in the future and coordinate action. So they're not all evil or something like that. I don't want to, that's just not true.
Yeah. There's not a lot. I mean, there are some evil people in your book, maybe, but that's not really the focus here.
No, not at all.
Right. Among other things, I see Bubbles and Crashes as a really neat interdisciplinary project, and I want to kind of give listeners a sense of how it came to be from the different traditions you guys came from. So, David, you wrote an earlier book on electric vehicles in the first decade or so of the 20th century, and you've also done some important work preserving the records of the .com bust of the first decade of this century. So how did Bubbles and Crashes connect in your mind to the earlier work that you had done?
Yeah, so for me, I realized actually both books, in a sense, were sort of social science history. I don't know if that phrase is still acceptable or au courant, but the idea that we kind of can combine or that we can allow social science to shape some of the questions we ask as historians. So the electric vehicle book was really started as a question about path dependence and lock-in. So that it really came out of conversations I'd had with people like Paul David and Brian Arthur when I was a PhD student at Stanford, and I was sort of looking for a case to test. It was my case selection was informed by social science, which again some of my historian colleagues might shudder at. Like, how could you? But I felt that was a worthy question that the social scientists might actually need some history to help them answer. Is the choice of internal was combustion an instance of path dependent technological selection where perhaps the best technology didn't win? That was the question. And in the same way, I feel like bubbles and crashes came out of this sort of when are there not bubbles problem, this sort of social science informed problem with sort of prevailing theories of bubbles that, I'm not a social scientist, and I don't play one on TV, but I kind of am just familiar enough and just interested enough in the kinds of questions that social science is asking that I feel like every now and again we have to bring, kind of take that deep dive into the history to figure out if we can help social science in that instance.
Mm-hmm. And Brent, you have a PhD in economics. So what made you want to work with a historian? Did something terrible happen in your childhood, or was there an expert?
David doesn't even know this. I didn't want to go into this. No. So yeah, yes, I have a PhD in economics, but my advisor was an economic historian, and I was always interested in history, actually from before I got my PhD, and so it was a very natural. Lee, there's two answers to this question. So the first is, I love going into libraries and smelling old books and picking up old things. And I feel that's a very soulful activity. So pursuing history and understanding history is a form of consumption for me. Having said that, I think we ignore history and the context of big economic phenomenon at our peril. I sometimes refer to economics as the asocial social science because its theory of behavior is so devoid of realism that it has led us astray in understanding how people behave and the motivations for those behaviors, and so I think that history provides, and in this case technological history because that's my interest, provides a tool to demonstrate the importance of understanding the contextual factors around decisions that, say, a pure neoclassical economist might ignore, or frankly be ignorant of.
That makes a lot of sense. One of the things I like about the book, and I think this is where the interdisciplinary social science history part comes in. One place it really comes in, beyond the theory building you guys do, is that you use this list of 58 technologies to kind of test out your ideas, which I think is just really neat. And is obviously not the way many historians of technology or business, for that matter, would approach the topic. So where maybe we should talk about that for a second. Where did the list come from? And, could you give a few examples just to kind of like show the wide variety of things on the list?
Oh, what a fun question. So I want to give David credit. He found the list, and for that. But I will point out, before David, I'll let you describe what's on the list. But I will point out that it was written by a Soviet economist, or it came out of a field of study founded by a Soviet economist who had this idea. I can never pronounce his name.
Kondratiev.
Kondratiev, thank you. Who had this idea that some technologies lead to, as they diffuse through the economy, lead to long-term growth. And I will note that this is kind of an inspiration for what is now general purpose technology, the theory, general purpose technology theory. And he has a very sad history in that he was executed in the Stalinist purge after 10 years in the Gulag. So I mean, it's like a very tragic figure as it happens. But he left us with this gift, which is this idea of long wave theory. And David, you want to take it from here? How you put together different lists?
Long wave theorists, this is sort of an arcane little backwater of academia that was pretty incidental to any kind of mainstream work in either economics or history, really. But there was a small group that was working on this idea of sort of economic long waves, and in the 1980s they commissioned a series of papers to try and identify the sort of the most important technologies, or to kind of periodize according to long waves. And so there was an edited volume, and we kind of plucked these compendia out of the edited volume, and then said, well, if the technology appears on all three or two of the three compendia, then it must really be important. And it has some, there's some really goofy things on there. I think that the automatic watch, the long wave theorists must have been really just enamored of their automatic watches, because that clearly was something really, really important. Or, what is it? The hydrofoil, or the is on there, and again, like, it's basically just an application of internal combustion to blow air over water, or whatever. But there are also some very interesting and important technologies that you would, I think, we do associate with these long waves, and things like internal combustion, and the telegraph and the telephone, and I'm trying to think of some other.
There's important chemicals like
nylon,
synthetic fabrics. Important processes of steel making, which are not that interesting to anybody except those that care about steel making, but are actually really fundamental to our economy.
Jet engine,
right? The assembly line on there, that's a big deal.
The assembly line, super important, but no pure play, right? If we go back to our model, like, how do you invest in the pure play of the assembly line? Not possible. I think, in retrospect, I think the list probably misses a lot of consumption-oriented technologies that if we were to redo it, kind of looking back across time, I think we might, you might want to think about things more from a consumption perspective, or think about things more with a little bit of a broader, say, gender lens, or kind of approaches. These long wave theorists were, white guys, kind of, sitting in various obscure econ departments or what have you. So,
but it serves the purpose.
Can you, I want, and I think it's a fun list. Just the mix of things on there, I think is really great. Before I lose sight of it, a couple times you guys have talked about, David's mentioned that the book was called Winter, They're Not Bubbles. So is the idea there with that old title that bubbles are ubiquitous, that they're around all the time? Or is it just like, when do they not develop around a new technology?
principally the latter, but I think the more we spend looking at this phenomenon, we may be more inclined to associate ourselves with the former characterization, like there are bubbles everywhere. And part of it is, when all you have is a hammer, everything looks like a nail. So I have a theory of bubbles now. Wherever I look, I see bubbles. It's
Yeah.
it, I try not to do that, although I'm sure my students would say I fail.
Yeah, I mean, it's a way to really focus the question on this epistemic failure in other studies of bubbles. Right? You cannot just look at bubbles and try to understand what caused them. You need cases when bubbles didn't happen. And so
Mm-hmm.
it was our device to keep the focus on that as we worked on the book. And then when we got to the final stages of the book, we got some feedback that that is really a terrible title.
Right. Okay.
And
I
so,
know that. I've lived that life too. Yep.
yeah, so we reluctantly gave it up.
Um, maybe we should. I should have probably done this earlier, but maybe we should talk about how you guys define bubbles, because that will help the rest of the conversation, I think.
Well, really, the following of our book is kind of a bubble. The so a bubble is when the value of an asset is beyond its, like, that's the traditional definition, when it's outside of its fundamental value, which would be defined as the long-term discounted cash flows.
Mm-hmm.
So basically, take the net present value. If you're above the net present value, then it's some form of a bubble. In practice, this is not a very useful definition, because at any point in time, you can't know what the future cash flows from any
Yeah.
innovation is going to happen, because or any firm, because there's just a lot of uncertainty about the future. What did Yogi Berra say? Prophecy is hard, especially about the future. Something like that.
Something like that. Yeah.
And so we default to something else, a more practical, a practical definition. One is that the 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 price has to be a historical anomaly, in the sense that it is, if you just project the trend 7 years back and forth, if you're two standard deviations from that trend, we're going to call that a bubble. We're going to call that a boom and a bust period, because it implies that it came up and then back down. And then if there were a lot of novices present during the time, we're going to then call the boom and bust a bubble. So if there are a bunch of inexperienced people investing and it went up and down, and we're like, yeah, there's probably a lot of mistakes happening in that market. And that, in practice, is how we're going to define a bubble. We then go even further afterwards, and we say, if we can't find a narrative that went along to explain this, we're not going to call it a bubble. Almost forgot about the narrative.
Mm-hmm. David, you want to add anything?
Well, I think the hard part is around rationality, and sort of you. On the one hand, I think we've wanted to try and talk to the financial economists and people who have thought about, sort of save the theory, if you will, try and explain away these aberrant episodes. And so we've tried, we sort of, I think, struggled around, is our theory a rational theory? And I think always bearing in mind that maybe the rationality is the exception, not the
Yeah.
norm. And so
With humans.
I think we're sort of dancing between that a little bit, and
Yeah.
we tried very hard to capture and represent these episodes in ways that a rational theorist could understand and test and evaluate, but we didn't want to just merely be confined by the requirement of rationality. So that in some of these instances, it is clear that the narrative is operating, and it's not necessarily comporting with a rational view of market behavior.
Mm-hmm. Dave, something I thought, I've talked to you about before, and I wanted to kind of get on the table before we go a little bit deeper into the theory you guys put forward, is that you both teach entrepreneurship, and I think you all see this book as connected to thinking about entrepreneurship and teaching entrepreneurship. So I wanted to talk to you guys a bit about that, how you see this book connected to entrepreneurship.
Such a meaty question, Brent. I can see the wheels are spinning. Go.
I just remember halfway through writing the book, and after the ideas of narratives really came out, because they weren't as present in the early parts of our thinking. And it was really as the book progressed and we evaluated what we observed that we came to recognize, or more correctly, I reluctantly went along with and followed David into this idea of the importance of narrative. And then at one point, I was like, well, you could think of every entrepreneur as a bubble of one, right? So the entrepreneur,
yes,
and that's important, right? And so and you see this all over kind of the tech entrepreneurship, Silicon Valley space, where it's very clear that one of the entrepreneur's job is to construct a story that places themselves, the firm, as a primary beneficiary of a future of some future that they are proclaiming will happen. It's a story. Mm-hmm. And so the question then, what distinguishes between an entrepreneurial story, or a pitch, if you will, right, and a bubble is how many people come along, and the connection between that story and what is plausible given what we know at a certain time. And there are, and those things can get pushed and disconnected, and we write. I know you were going to go there, but I'll take you there anyway. Like, one of the examples that we write about in the book, and David and I are on record, is Elon Musk is a master at exactly this, at trying to manipulate the story to get people to invest and put money behind Tesla. And we both underestimated, in a way, we underestimated the power. Here, let's frame this in a positive way. We underestimated the power of our own argument around narrative, because certain actors can really drive a story and change the historical outcomes.
Yeah. Let's go to Tesla. I want to loop back to entrepreneurship at some point, but I think we should get it on the table. I think people can go back to my old tweets and see that I've made false predictions about the near-term viability of Tesla as well. So I think all three of us have done that. Brent, I think you actually shorted them at one point. Maybe you're still doing
that. I bought some puts, and which are have long since expired outside the money. So yes, I lost a little bit of money. Not a huge amount, right? Because I knew not to do that, but
yeah, it's a good. I should do that too.
No, you shouldn't.
It'll make me more honest.
Just give me the money instead if you want to waste your money. That's cool.
All right, right on. Why do you think we got Tesla so wrong? Do you think it's still a bubble, and it's just lasted longer than you predicted?
David, I will point out that it's down, like 20% in the last couple of days. So
Yeah.
it is. Uh, David, do you want to take this? I'm monopolizing it.
I'm, really am struggling with Tesla because I feel like,
Yeah.
I may have sent this around. I'm happy to, have you share it again. I set up this little spreadsheet where, you put in 7
Mm-hmm.
assumptions and it spits out um, a stock price for Tesla and, 5 years from now, and then discounts it back. And, I defy anybody to actually come up with a fundamentals based argument for the present,
Yeah.
stock price of Tesla. It just is not, it's not reasonable. So I think we are observing something weird. It doesn't, I'm not,
Yeah.
I'm not an institutional short seller. I'm not out there. That's not my job. My job, I think, is to try and understand how technology and gets kind of packaged and sold in some way by entrepreneurs, and hopefully to try and
Yeah.
see past that a little bit, see that larger context in which those activities take place. And so for me, I continue to think it's like, it's not an $800 billion firm or a $600 billion firm or whatever. It's probably more like a $50 billion firm, maybe 75
Mm-hmm.
or 100. So, again, I'm not that I'm giving anybody stock advice, but like this just, it still seems pretty crazy to me. And so then I think we have to try
Yeah.
and understand, well, what's going on? And here I think I haven't really seen this connection made very yet explicitly, but I think actually, if you look back to the GameStop and the AMC kind of, uh, you know, um, kind of bubbles of the last month or so, I think that those techniques, these kind of social movement stock kind of mobilization, I think those techniques were
Mm-hmm.
actually pioneered by the Tesla Bros. And in fact, it was those activities that sort of chased the shorts from the market. And once, if you look at what the short sellers said when they closed out their Tesla investments, if you look at,
Mm-hmm.
they'll say things like, it's not that I'm now convinced the company is worth, X.
Yeah.
It's that I can't fight the story. I can't
Yep.
fight the mob. And so I think, anyway, I think, again, I kind of, some part of me hopes Tesla really is worth that much, because then it would mean, wow, there's like, we could have something that big and that transformative occur in the world. But I just don't think it just doesn't feel
Yeah.
real. And so then I think we are kind of back to sort of understanding, well, who are these novice investors? They're like Robin Hood, Tesla Bros, trading on margin with fractional share ownership, and, the classic novices. There's massive uncertainty, and talk about a story. You've got this Svengali of a storyteller with 40 million Twitter followers out there kind of spinning yarns. I like, wow, I think it's the thing we have to stop, not like, or really understand,
Right.
so it doesn't happen again.
So all right. So I'm going to argue both sides of this coin right now because I don't know. So I completely agree with David that Tesla must be overvalued as a car company, and even today you see this. Is it a car company or is it a technology company?
Yeah.
I don't know what a technology company actually is. Companies
Yeah.
compete in markets, and those markets should define them. There is some sort of autonomous vehicle story floating around, but that is
Mm-hmm.
probably one of the most competitive markets on the planet right now in the race to dominate that space. And so I'm not arguing. I do not argue that Tesla is valued correctly. In fact, there was a tweet today. I don't know if we should bring it in current affairs, but there was a tweet today that Tesla had made more money in the last couple of weeks in Bitcoin than they ever made selling cars. Which I think is probably true. Like that I didn't verify this, but it's a very plausible statement. The flip side of this is, I think it's also hard to argue that Elon Musk and the Tesla bros did not accelerate the move to electric vehicles and did not create a competitive response from GM and Ford and VW and less so Toyota, because Toyota is a very conservative organization. So this is real, and this is the power of narrative to keep going. And if you want a prediction of Tesla, I can give you the prediction. Tesla will keep going so long as it can raise money through selling fictional stories or through selling cars, right? And so far it's been mostly selling stories to investors, and that has been their source of revenue. At some point, and this is what you can't predict, this is the Abreu and Brunemeyer paper, which we talked very briefly about in the book, that it's very difficult to coordinate around when the music will stop, because you don't know when it's going to happen.
Yeah.
And so that's a big problem for short sellers.
I think, Brent, you said once that Elon Musk is the most, it's not J.K. Rowling, it's Elon Musk who's the most successful fiction writer on the planet.
Yeah, he's good.
He's good. He's a good storyteller. Give him credit.
Yeah. Let's come back to entrepreneurship. So, like the way, one way I could take your message is that the book provides models for spinning narratives for your entrepreneurship students. Like, here's what success looks like. Is that the right way to take what you're saying?
In practice, no, because telling, the exception proves the rule. There's very few people who can do what Elon Musk does.
Yeah.
Yeah, and we should not expect that most individuals, including our students, will ever do that. Nor do I think most of them actually want to do that either.
Yeah.
And so, but at the same time, I think that understanding that if you're going to bring somebody on a journey into an unknown future, you have to tell a story about that. And that's not a terrible thing. That's a tool of the trade. But it makes it difficult to define when you're telling a good story about a promising future and when you're a huckster. And you have to, at the end of the day, you have to believe what you're saying and hope that you're getting enough checks and balances from the stakeholders around you to keep you honest.
Yeah.
There was go ahead.
No, I was just going to add, I think the one thing that Brent and I have both been very clear about for a long time, we've been teaching entrepreneurship together, designing courses together for a long time, is, we don't teach our entrepreneurship courses to produce entrepreneurs. We've been really, very transparent about that we want to educate people about what entrepreneurship is. So, we had this sort of notional test of moving the needle. Come in with all your preconceptions. Tell us how you feel about entrepreneurship. What valence do you bring to it? And then our goal over the course of our classes is to move the needle, not move it more positive or more negative. We just want to move the needle to kind of shake you, give you some insight into what this thing called entrepreneurship really is, that you've picked up from all these cultural, you've been watching too much Shark Tank or whatever. Like, wait a minute here, this is the real thing. And so for us, like, storytelling, that's part of it. Not certainly not all of it, but we're definitely not trying to create the entrepreneurship toolkit for the future here. This is very much like,
that's interesting.
At least in the way I think we approach it is, we want to demythologize it, and we certainly don't want to. There's this kind of, I think, very legitimate concern that the kind of corporatized university has just like put all its chips in on entrepreneurship and innovation to sort of. I'm not sure quite what to commercialize technology or to generate revenue, big donors.
Yep.
I'm not sure exactly what the overall logic is, although obviously innovation's critically important. Lee, you know that more than any. But I think, Brent and I have been very careful to not be on that train, so that you can take an entrepreneurship course and graduate, do well in that course without walking out sort of brainwashed into thinking you should become an entrepreneur.
Yeah. In fact,
that's really interesting. I mean, that's how I teach. Oh, go ahead, Brent.
Oh, I was going to even just to double down on what David's saying. The evidence is if you want to become an entrepreneur, the best age is somewhere around 40, not 20.
Right.
And undergraduates, young people don't have a lot of worldly experience because they're young. And it takes time to gather that, and that helps you a lot navigate the uncertainties and the ambiguities of entrepreneurship.
Yeah. No, it's interesting because this is how I teach my innovation class too. It's, I have people explain to me what innovation is and how it works. And then the first half of the course is actually oriented around myth busting, where I do exactly what you're talking about. And one of the things I talk about is the over 40 entrepreneurs thing, because I'm like, you need to know markets. You need to have some domain expertise. You need to understand, you need to have social networks and understand social networks. And that's all stuff that you really need to be in a bureaucracy somewhere to learn about before you go off on your own. So I want to talk a bit more about narrative. Brent, you put this on David. So, David, do you remember when this started popping out to you that narrative played an important part in this story?
Well, I think in a way we considered a number of other aspects of the model. Like, we weren't sure it was narrative initially. We talked about coordinating events, right? Events that kind of coordinate beliefs, and maybe it wasn't that you need a consistent narrative across time, but you just need, President Polk saying, there's gold in them thar hills, and you get a gold rush, but we realized that in fact, for a lot of the technologies where we did bubbles, we couldn't find single coordinating events. So that was like that theory was a little too parsimonious and it was like too clever by a half. It didn't really work. Or we also at various times thought about retail facing. Oh, the technology has to be retail facing for there to be it has to kind of touch consumers in some way. And if it's a consumer facing, but then we would find technologies that are consumer facing that didn't have bubbles. So like that didn't work. So I think we kind of had to iterate to it and kind of come around to this idea that there was something about how people understood a technology, and that understanding a technology didn't happen from a blackboard or a technical report, but happened sort of in conversation, in narrative, and how it was reported through the media, et cetera. So I think it wasn't that I was like, oh, I'm a historian, I'm going to talk about narrative. I think we sort of backed onto it in a way, or backed into it because some of our other explanatory concepts were inadequate.
Mm-hmm. Yeah. Brent, you want to add anything?
No, I think that the only thing I will add, and but maybe I've already said this, is that the power of narrative and our understanding of it really strengthened over time. So like I think one of the key moments for me was the space race, and so there was kind of an aviation jet engine sort of storyline behind the bubble in jet engines in the late 50s, and the storyline was all about the space race and defense. It wasn't about I'm going to go buy a jet airplane for myself. Like I guess you had that in the Jetsons, but as one offshoot of that storyline. But the reality is that's not what the discourse was. And then you realize that it's like, okay, it's about things that make for good stories as opposed to and command our attention. And that can come from the fact that you use it, which is where we started with the retail technology, which, by the way, still matters. Like, I don't think Tesla would be what it is if the same people investing in the stock didn't also own Teslas. And probably you could think of Bitcoin in a similar sort of way. But at the same time, that's not sufficient. It wasn't good enough. And we needed an explanation that was a little bit more powerful. And that's where narrative came in. So
I was going to ask you guys to talk a bit about naive investors, but I think maybe we can talk about them in a different way by just asking a simple question. Do you guys think we're in a tech bubble right now? We talked about Tesla, but do you think the bubble's bigger?
Oh, David, this is your entree to talk about specs.
Yeah.
Right? Like it's the perfect time.
I think there's been this real explosion of these special purpose acquisition companies, this known as SPACs, where you just
SPACs,
where everybody is, A-Rod has a SPAC, Shaq has a SPAC, every kind of 2-bit billionaire has a SPAC, and they're out there, kind of raising money to then go overbid for taking private companies public, when the incentives are all screwed up and the SPAC kind of organizers are going to get 20% off the top, and there's lots of uncertainty in those processes. So I think, it's a parlor game around Silicon Valley. Are we in a bubble? Oh, and people kind of adduce the arguments pro and con or whatever. But I just think it's very hard to, when you look. I guess my real concern. So I actually bring this back to Tesla in a way. I think a lot of these SPACs have been electric vehicle, alternative fuel, battery technology based. There's probably not certainly not the majority of them, but probably I'd guess 10 or 15% of them have been electric vehicle based. And the argument goes something like, well, if Tesla's worth 800 billion, we're worth at least like 5 billion. And so and you're like, no, but you're not, because Tesla's not. And so I think there is this kind of, Tesla is kind of the penumbra under which a lot of this kind of bubbling logic kind of is protected and spreads. And so I think, my real concern is just where do the bubbles kind of, what isn't the bubble right now? How you say, oh, well, it's SPACs. And then you say, oh, well, no, it's, what about it's the S&P 500 because, it's that's a $30 trillion market cap and Tesla's, 4% of it and you own it in your 401k that, has indexed
Yeah.
investments. And then you say, well, it's all being, kind of propped up by the Federal Reserve's balance sheet buying junk bonds. And you're like, what is or munis or whatever the Fed is
Yeah.
buying today? They'll buy whatever, they can. So anyway, I get a little bit lost figuring out where the bubble stops and where the fundamentals begin, and that's where I hope Brent will save
Yeah.
us, because he's actually an economist and not
I,
a paranoid
Uh,
person.
I was gonna. I'm not a macroeconomist, nor am I a financial economist. Thankfully, for my own sanity. But the one thing I will add about SPACs is that these are opaque, they're opaque instruments, and we know that the the companies that are purchased through SPACs are not vetted in the same way as an IPO, because in this sort of kind of backdoor IPO process. And I would imagine that many of the investors in SPACs are not expert investors either.
yeah.
Right? And so you have precisely the conditions for a bubble, where you've got an instrument that is not well understood, that appears to be fail-safe, because with a SPAC you can always just get your money back with interest, and that is, and it seems very unlikely. And then you've got some, if it's very unlikely it's not a bubble, then you have some powerful narratives behind this, such as mobility and electric vehicles, which are kind of convergent narratives. There's nothing that requires a self-driving car be electric. And those sorts of things are, and this imagination of a world in which you push a button and a electric car comes to your door and drives you wherever you are while you get to play Tetris. I guess you don't play Tetris anymore. Dating myself. Is attractive. That's a really attractive narrative. And so it shouldn't surprise us that that could be a focus of a lot of speculative activity and a bubble.
Yeah. I guess I don't know if you guys have been following the work of Jeffrey Funk, or if you agree with his analyses, but he's been doing a lot of analysis recently on profitability of IPOs and startups more generally, and in using like a 10-year cutoff as like, startups are going to be unprofitable for a long time, but like let's start looking at like firms that have at least been around for 10 years. And he finds that like compared to like the 1980s and 1990s, profitability is like way, way down. Like it was over 80% for unicorn firms, it was over 80% in the 80s, and now it's like under 20% or something like that. And then you like start looking at the firms like, Lyft and Uber and WeWork and, Grubhub. I mean, the list is like quite long, right? Of all these like kind of hot firms that are not profitable. And, they all have narratives around them. It's for me, for most of these things, it's actually quite difficult to see how the business model would be like high growth at any point or high profit. So I guess like that's when I ask the question, that's the kind of broader context I was thinking of, is like not just Tesla, but there's actually, I think, and then Brent, you put it on Twitter once. You put it this way. You said something like, you didn't use the word bubble. I'm going to substitute that word. You're like, you can expect a bubble when like traditional firms describe themselves as like digital firms or something like that, right? And that's the shared thing about all these companies, is that they're all like digital data. I'm putting quotation marks around these words. I don't know. Yeah.
So it's quite so. Yes, and we've. I have like three answers to your observation, or three comments to your observation. Hopefully, I'll get to all three. Or maybe there aren't really three. But like one is, it's very interesting to compare this to autos in the early 20th century, because autos were profitable, or some of the kind of the leading auto companies, many lost money and went bankrupt. But the profitable ones were profitable from the get-go. Ford was founded, like the Ford company that eventually survived, there were three of them, and the third one was the one that worked, was founded with $5,000 of investment capital, think $50,000 to $60,000 today. It like not a lot of money. And they were able to bootstrap the entire venture because they could sell their cars before they built them. And they financed it that way, and it was one of the most successful enterprises of the 20th century. And just in contrast, like to really emphasize the point that Jeffrey Funk is making, and this is similar to what we saw during the dot-com era, where David and I wrote in our paper that it was all about, get big fast and worry about the profits later. A very, very similar sort of argument. And so, yes, this is a big problem. It's really interesting to think about not just the companies that you're mentioning, like Uber and Lyft and Grubhub, but there's another interesting company called Luckin Coffee, and Luckin was it was traded here, but they're now bankrupt, which is kind of the point of the story. But they had this idea that they were going to be a coffee network. I don't know what a coffee network is, but it's in their S1, and they were going to compete. They're a retailer in China, and they basically just delivered coffee to people. And so the idea is they would have these kind of light real estate stores, unlike a Starbucks where you actually go in and sit and drink your coffee, and people would order coffee, and they would, and you get it delivered. And if you've been to China, you can get anything delivered by somebody on a little scooter. And they were caught fabricating their sales data, so literally fraud. And this eventually led to the bankruptcy of the company. And so this is just the extreme version of a story. Like, they needed a story that would command investors. They decided the story was they needed to have some plausible path to profitability, and they couldn't generate that, so people inside the firm made stuff up. The difference is, and this is really interesting, Uber and Lyft, if you look at their S1s, they make similar sorts of statements. Lyft is kind of the worst at this. They're basically saying, you bet on us now, and we're going to control the self-driving car space and be like the app that everybody comes to. They've since divested any interest they have in self-driving technology. And it hasn't been sustainable. Their business isn't long-term sustainable. The cool thing is, as a way to think about those companies, is that the sovereign, the Saudi sovereign wealth fund is subsidizing our transportation through Lyft and Uber. And I guess that's nice. It hasn't been so good for the drivers.
Yeah.
Yeah, but I see the day of reckoning will come.
Yeah, and the Saudi sovereign wealth fund is going to get paid back by the Lucid SPAC.
Yeah.
To compensate some of their billions of losses.
Yeah, there was a really nice piece in the New Yorker maybe a month ago, and they make the point that, and they talk about WeWork. WeWork is kind of the main protagonist that links together that narrative. And the investors, the VCs in WeWork, they got out fine.
Yeah.
It looks like they do not lose money. Right. There were a lot of other people that lost money. Right? Yeah. But in the game of musical chairs, you just have to be not the last one.
You guys end the book by talking about public policy, and I think that's a nice place to land, actually. So, I think hype is normal, around technology markets, and as you've said, part of entrepreneurship is creating narratives of kind of glorious futures that the entrepreneur and the company are going to be a part of. But what is the implications for your theory for policy making and how we should all be thinking about these issues? David, do you want to kick it off?
I think it just our level of general financial literacy is so poor. So when I think of that poor kid, the Robin Hood kid who committed suicide because he didn't understand what options were and margins, and didn't. I mean, I just that's. And so I think we're and so I think we need so much more, so much greater financial literacy than we have. But I also just think, like, our lives, just if you ask me personally, this is not in the book particularly, but it's sort of our next book, is like we're way too exposed to markets. I feel like in our lives, I think our well-being is just way too. We shouldn't be. Like, I'm all for capitalism. I am. I think it has improved our lives in countless ways. Even people who were not themselves, who were exploited by capitalists. Their kids live longer because of capitalist economic development. So we don't want to throw the baby out with the bathwater. But man, it is just if we don't try and figure out some way to insulate our day-to-day existences from the vagaries of some of these kind of fluctuations, we're just not going to be a very happy people down the road.
And I should point listeners to Scott Sandedge's book Born Losers, which is a kind of history of how our lives became intertwined with markets in ways that just weren't true before the 19th century or so. Brent, what do you think about go ahead, Dave.
No, and I love Scott's book, and I think it really does, like, we're just kind of living the 150 years past that in a way of, more and more kind of exposure to those forces.
Yeah. Brent?
Yeah, so in a way, I think that chapter is the weakest part of the book. So if we're going to choose not to read any particular chapter, that's the chapter you don't read. The main point behind it is that investors should spend a lot more time understanding what they're investing in. And the old adage, which we know, if a story is too good to be true, it probably isn't. And so understanding our own susceptibility to stories in good stories, I think, can really avoid a lot of heartbreak. And if I were to, that would be the primary thing. Like, we have some ideas, or we've thought about some ideas of what you could do to taper some of these effects. Like, you could imagine an S1 where they have a success narrative and a failure narrative. Because right now what they do is they have a success narrative, and then the risks are just a list that aren't put together in a story. Well, if we understand that people think in stories, let's create that failure narrative and
written by somebody else, maybe.
Yeah, exactly. And put that together, and some people will say, well, that means that fewer people will invest and my value will go down. And I would say, yes.
Right.
Like that's the point. But I don't want to lose. I'm not down on capitalism generally. Like my advisor Nate Rosenberg, he liked to talk about one metric, which was maternal mortality in childbirth, and it used to be 1 in 6 women would die in childbirth over the course of their lives, and that means that everybody you knew, like you knew somebody who died of childbirth. And today, I think many people don't know anybody who has died in childbirth. And so that is just a wonderful improvement in the human condition. And it came about because of the system we live in, which has been capitalism. And so
you talk about mundanity. I mean, people just don't understand the C-section as like maybe the most important life-changing thing that was, in medicine that was ever created was the modern C-section.
Not on our list
guy,
because it was a bunch of white guys.
Right. Yeah. Fair. Guys, David, you already kind of mentioned the point of the next project. Is it a book about entrepreneurship and how to do better on these issues? How are you guys framing it now?
So I think what we're really that's the most hurtful question you've asked all day, because we've been so busy with thousands of other things we haven't talked about it. Really, it's well, actually over the summer we did we had a little reading group with a impressive young student who was helping us kind of understand some current writings about capitalism and helping kind of orient our thinking. But I think we're calling it, again, for lack of a better word, I'm sure the editors will eventually talk us off of this, but experimentalism. And trying to focus on this idea of economic experiments as really the essence of capitalist economic development, and that what we want to try and do is, as we think about designing our social systems, behind the veil of ignorance, et cetera, we want to maximize the fraction of people who can undertake economic experiments, who can engage in entrepreneurship, not out of necessity, but out of desire and opportunity. And I think that's, I think there's some kind of common interest here. I'm thinking of like Raj Chetty's work on the lost Einsteins, this project that looks at, patents that weren't filed by people who lacked resources and complementary assets that would have allowed them to generate innovations, et cetera. So, I think that's kind of the direction we see this next project going, is kind of maybe a little bit entrepreneurship for everybody, or as many people as possible.
Yeah. The flip side of that is that a failure to democratize, I don't know if I want to use the word democratize, it's such a loaded term, but the failure to provide opportunities across our society is fundamentally destabilizing. Capitalism in of it itself is a system that is unstable because it has incentives to innovate and replace things in the past, and that makes jobs obsolete, makes firms obsolete, etc. So it is a fundamentally unstable system. And I think we've seen many times in history, when the fear of that lack of stability, or the fear of change, has led to some pretty negative political forces and demagoguery. And you can think of Trump, you can think of darker movements like Nazis, and like all of those movements came out of really uncertain times and difficult situations for a lot of individuals. And so if we don't address the stability of the system as a whole, we may not have a system.
Yeah. Well, we should stop right at that very dark place and just leave it right there, I think. Guys, this was as fun as I thought it would be. So thanks so much for talking to me today.
You bet. Our pleasure. If we ever start a podcast, you'll be our first guest, Lee. I know you.
Absolutely, Lee.